Hello, everyone. Welcome to the market update for Tuesday, June the 21st. As always, if you have any questions during the week or any that I don't get to in the live class here, make sure you send those to Jerry at traderspro.com. Today's rally isn't unexpected. I know last Thursday we were talking about the possibility that the market could start a panic sell-off where we were at. We had attempted to rally on Wednesday and then rolled right back over on Thursday. Same thing could happen here. I mean, there's not a lot of volume in the rally today, and at times we've kind of come off the highs of the day and faded a little bit. We'll see how we do going to the close. Overall, I still think that any rally would be a rally within the downtrend. I'm still pretty cautious about buying a lot of stuff right here. In fact, in the portfolio, I've gotten out of everything but oil. I'm just holding oil right now, the USO, and we'll take a look at that here in just a second. Just kind of a dangerous spot. When the market starts acting like it could go either way, and you don't feel like you can. Where you can't really read the price action. We're not getting real distinct candles that are forming. It's usually a signal to be cautious and to maybe sit it out a little bit. I don't like to be in market environments where I feel like I'm guessing, and we're definitely getting into one of those phases. And part of the reason for that is the fact that we are whipsawing a little bit. We'll look at the charts here in just a second. But the fact that we rallied today isn't surprising given the fact that we are oversold. We talked about that in the last update, the indicators being at the far left side. You're at the far left side here on the bear market. This is obviously a longer term indicator, but it's signaling that you're probably getting close to a bottom. And then you've got your shorter term signals that are momentum is at the far left side. Breadth is at the far left side of the extreme range there. And the sentiment is still relatively high. And again, it's stayed in this range for quite a while. As I told you, the problem here is that we're oversold, and it's showing that the market is due for a bounce. We'll look at the indexes here, the buy-sell ratios on the indexes as well. I went over this last Thursday as well, but I'll briefly cover it again. So there's a lot of indicators that are saying that are showing bottoming type behavior. Again, the last thing we're really looking for is that sentiment to come down, that the VIX to spike, to get a little bit of fear in some of the selling. Now, part of the problem that I see, and this is just, again, the natural tendency for me to be a contrarian. I've been talking about, panic selling and needing to see panic selling in the market. I've been talking about this for a long time. Many of you are probably sick of me talking about it. But the problem I'm starting to see is that there's a lot of people talking about it. There's a lot of people on CNBC saying that, we need to have a panic sell-off, and rightly so, because it happens so often. Okay, it's one of those things that if you've been through a number of these market sell-offs, you've seen it happen, and so it's one of those things you start to look for or expect. But again, the contrarian side of me is saying, okay, if everyone's looking for the same thing, then the market will find a way to not give it to you, or not give it to you in the context of what you're expecting. Rarely does the market move in a way that the majority thinks it should move. And so anytime you have a belief of what the market is supposed to do, and you hear a lot of people echoing the same belief, just try to develop a natural skepticism of that belief, because the market will usually find a way to not perform the way the majority of people think it should perform. I can't explain why it does that. It's one of those things that you really can't quantify. But it's not just in the markets. I've mentioned this before. It happens a lot in sports. Um, when a team is supposed to destroy another team, and everyone believes that team is supposed to win, and it's like, why even play the game? We all know who's going to win the game. Very often the underdog ends up winning, and it happens enough times to where there's something to it that you can't explain it, but it's one of those things that you can't calculate it, but it exists, and I don't know what the law of the universe is that causes that to happen, but it happens a lot in the market where, again, when something looks obvious or it looks like the market should make an obvious move, it sometimes doesn't. So how does that relate to our analysis? Well, it's making me believe that the market might do something that throws everyone off. And, as I keep looking at these, the indicators here, I mean, all of this is showing a bottom. You've got, again, the long-term indicators, all the short-term indicators. We're showing all these extremes that says the market should rally, and it makes me wonder. The only thing missing is the sentiment. The only thing missing is that the VIX the fear isn't there, and again, everyone's expecting that. So it makes me wonder if at some point we're going to get a rally that extends a little bit longer than most people believe it should extend. Because every time the market starts rallying, I keep hearing on TV is that that's just a bear market rally. We're going lower, and it makes me wonder if we're going to get a rally that lasts a few weeks to where it gets to the point where people say, hey, maybe we're not going to get that panic sell-off. Maybe, maybe we have bottomed, because a lot of people are noticing the same bottoming indicators as well. And then you might get a chase where people start feeling like they're missing out because that maybe, like I said, maybe they believe this time we're not getting that panic sell-off, and they start chasing a rally. And then we get a rollover and get a massive sell-off that causes that panic. I don't know. I'm just kind of trying to play this out in my mind as to what some of the possibilities are. And it just goes back to knowing that I'm expecting this sell-off. Everyone's expecting a sell-off. These we're probably not going to get it the way that we think it'll happen, meaning thinking it'll happen right now or during this trend. Now, it could be wrong, and maybe we do get it. Another possibility I've talked about is that maybe we get a panic sell-off, and then everyone thinks that's it. It's the market starts to rally, and everyone thinks that's it, and we get another panic sell-off or maybe a couple more panic sell-offs. That's another way it could play out as well, to where we get it, and then people think that's it. They start buying, and then it rolls over again and gives you another one. That's definitely a possibility of how it could play out as well. So again, I'm not saying this to try to predict. Our job as trend traders is not to be psychics, but we want to be prepared. So if we do see a rally that seems like it's lasting more than a few days, and we're going to try to participate in it, but we're going to be cautiously participating in it, knowing that could be one of the scenarios that we rally for a few weeks and then it rolls over. And so I'd still probably be a little hesitant to be overly aggressive in the buying at that point. So anyway, I'm just going through some things that's been running, some possible scenarios that have been going through my mind recently, and trying to tie everything into my experience and what I've seen in the past. And it's just one of those things where, again, if I hear people agreeing with me on particularly on CNBC, I start to immediately get skeptical of my own analysis, because usually when I'm right, it's when I'm looking at things that are opposite of what everyone else is expecting. So now let's go over to the buy-sell ratios here again, showing an extreme. they're look how wide we are. We're getting close to where we were back a month ago, and already we're in an area that's a normal extreme level. This sentiment indicator here is down around the green line down here, which is again showing an oversold. Again, all these are showing oversold conditions. And then, like I mentioned last Thursday, if you go on the index tab right here, these buy-sell ratios, these are looking at the buy-sell ratios of the different indexes, and you can see they're very extreme. There's a ton of sells versus buys. I mean, look at the Russell 1000, 670 sells, only 7 buys in a index of 1,000 stocks. The Russell 3000, which is basically all the main tradable stocks that are not, they're the big enough companies that, that you would want to be investing in. You've got 1,500 sells versus only 70 buys. So these are extreme. You can't get more extreme, much more extreme than that. You can get more extreme than that. We saw that at near the bottom of the COVID collapse a couple of years ago. We saw really extreme levels. But again, the point I'm trying to make is that these signals are telling us that we're near a bottom, and it just might not be the bottom yet, and that's part of the problem right now. We'd like to get aggressive, but and to be honest with you, if I liked a little bit more of the charts out there, if a lot of the charts were acting like they could be reversing into uptrends, I might be a little bit more confident into adding a little bit more to the portfolio here. But it just feels like it's still a little bit early. But we are getting close, and I know it. Like I said, that these last few classes have probably been a little bit boring because we haven't had a lot to talk about as far as specific trades to get into. But as I keep pointing out, I think our patience is going to be rewarded because it'll allow us to get in closer to the bottom to where, again, then it'll be really easy as we see things rally back up and it'll seem like the money we're making is easy money at that point. Another thing to point out is that if you're expecting the market to bottom when news comes out that we're in a recession or the worst economic news that people have been kind of dreading starts coming out, typically that's not the way it happens. A lot of times the market itself will start to rebound. It'll actually start to rally, or it'll usually already bottom before you start to get the worst news. Meaning if we're going to get news of a recession, the market might bottom already and start rallying by the time we get that news. And so just be aware of that as well, because it seems like the obvious thing. We'll just wait until we hear that we're in a recession, or we hear that things are getting really bad. Like I said, a lot of times the markets are already recovering at that point. Now that's it's still an area where you can still get in and still make money. That's the nice thing, is that especially if you're just getting into trading right now, we are much closer to a bottom than we were, 3 months ago or what have you. And so, even if we don't time the bottom perfectly, in the long run, if you're looking out several years, we have come down enough to where you're probably pretty close. And so, and again, these indicators would reflect that as well. All right, so let's get into our charts here. And I talked about this on Thursday as well. Kind of an area. Well, I'll look at the longer term chart here in just a second. So again, we're getting this bounce right here. So this is what we were looking at last Thursday. We had the attempted bounce on Wednesday, and then we immediately rolled over and dropped a pretty dramatic drop. And I was expecting, we were oversold right here. We were expecting to see a little bit of more of a rally off of that. And then immediately we went lower, and it wasn't like we went down to the bottom of this range where we could say it was still part of a sideways correction. It actually broke to a lower low. So at that point, you see the VIX spike back up again. You have to wonder, we're already in an oversold condition. Is this where we start to see, panic start to kick in? That's another thing too, is again, on these sell-offs, we're seeing orderly selling taking place, meaning that, you're not seeing these wild swings throughout the day. That's a signal that we're getting panic selling, is when you'll see the Dow down, 1,500 points or 2,000 points, and then a half hour later, it's come back to only down 1,000 points, and then it's back down to 2,000 points a little bit later. You see these wild swings throughout the day, and what causes that is it's a lack of liquidity. There aren't any buyers. Everyone wants to sell, and there's nobody to buy. And so when these prices drop, there's nobody to buy, and so they drop very quickly. They drop very dramatically until there's some buyers there, and then the buyers push it up a little bit. And then there's more selling to push it back down, and there's no buyers there. It just drops very, very quickly. So that's a sign of a panic sell-off. Sometimes what will happen is you'll see the curbs kick in. There are price controls that keep the market from just completely crashing. Some stocks will get halted temporarily. That's a sign that you're seeing panic selling, and it becomes more dramatic because these computers are out there and they create a lot more volatility as well. These high frequency traders, and but anyway, that what we've seen with some of these big sell-off days is not that. We've seen it just steadily move down. They might gap down at the open, which is very common, but then as it keeps going lower throughout the day, it's very controlled. It just kind of keeps slowly going lower and lower and lower and lower. That's kind of more of a controlled type sell-off. And again, the VIX will reflect it as well, because the VIX will just spike, just a huge spike when you're in those panic situations, because traders are, if they can't sell, they got to protect their portfolios, and so they'll go out and they'll pay whatever price they can pay for those protected puts, and that causes that implied volatility to really spike up as well. By the way, when you get into really wild markets like that, the best you can do is be out of the market. You don't want to be trying to buy in those situations necessarily. You definitely don't want to be trying to sell with everybody else. Hopefully you could just sit back and not have to participate, because it can get really crazy. You're trying to get out. And by the way, if you're ever in those situations, don't you ever use a market order to buy or sell in those situations. You're always using a limit order because of the fact that the prices can move so dramatically. You could put a sell order in that you want to sell it. Let's say your stock is at $150 or something. You could put a sell order in. If you put a market order in, that stock could have such a drop. There's no buyers. You might be getting out at $70. It could lose half its value and then come right back to $150 again. You got out at half its value because you just wanted to get out, so you used a market order, and then it flips right back up again into that range. You can see some wild swings back and forth. And the same thing could happen if you're trying to buy in those conditions with just a market order. You might think you're buying it $150 and it has a huge run up to where you end up buying it at 200 or something, and so you always have to make sure you're really careful in those type of conditions. Best thing to do is stay out of them, but if you're in them, make sure you always use a limit order when you're placing that order in those types of conditions. Now in the near term, like I said, you can already see from the chart that we were extreme had this big drop very sharply in a short period of time. So in the near term, we were oversold. Over the longer term, we were oversold as well. We've had this aside from this little rally right into here, we've had a pretty extended drop. So we're due for a little bit of a bounce. I don't know if today is the start of that. Like I said, I thought Wednesday was last week, and that didn't last. There isn't a lot of volume behind today's move, which would tell me it's acting a lot like a rally within the downtrend. But, I could see, here's about a 50% retracement up here of that drop. You also have a little bit of congestion right into here. And so I'm looking at a range right in this area right here that I think we could rally up to. And now, again, it could be that, it's choppy. Maybe we're down tomorrow and then up on Thursday. Maybe it chops its way up there this week. Maybe even extends into next week a little bit. But it's hard. See, anything's possible, and that's what makes it really difficult to know in the near term what can happen here. Like I said last week, when we drop back down here, it's possible that you get that panic sell-off right from here. People are expecting a bounce. A lot of people recognize that we're oversold already. Sometimes you can get those big sell-off moves in that type of condition. But another thing to keep in mind is a lot of times those big sell-offs are triggered by some sort of headline news. I've talked about this recently as well. And a lot of times it's news that the market isn't expecting. Now, how can we anticipate what we don't know? How can we anticipate a headline that could come up in the next week that we're not expecting? You can't. But the reason why that's important to understand is if we do see a day where there's some sort of headline and the market is selling off in a big way, that could be a trigger that causes a bigger sell-off as well. Selling that's accompanied by a headline can be something you would look for as a possible starting point for panic selling to take place. But since I don't anticipate anything like that this week, we don't have a Fed meeting. We don't have any major, at least that I'm aware of, any major inflation report coming out this week. I think that we're more likely to rally up or be choppy back and forth, whipsaw a little bit back and forth here over the next few days. I do want to go back and revisit this up here again. This was one of those situations because back here we had this impulsive move up and the wind moved sideways. Based on that pattern, that chart behavior, there was a very high probability that we would have at least another move up. We never got that. We had this drop that took place. What happened in that situation is we got the lower probability move. That doesn't happen very often. But again, this is a reminder that the market will sometimes do the lower probability move. It will sometimes throw you off. This is what keeps the market the market. You can't have a marketplace if everyone knows what the market's going to do next. And in order for it to keep that edge that it has, that you can't know exactly what it's going to do next, it's got to do the lower probability move from time to time. What that means is that no matter how well you anticipate what's going on, no matter how well you trade what's going on, you're going to have situations where you're going to lose money, and you're going to lose money because the stock or the market made the lower probability move. But that's part of the process. This is why your money management, your trade management is so important. This is why you can't go into trades with everything risked, with everything on the line. Because if you do that on a regular basis, you're gonna get wiped out of the market at some point. It's going to happen. It's not if it's going to happen. It's just a matter of when is it going to happen. if that's the way you are trading, you're not going to survive. You are going to lose all your money if you put yourselves in positions all the time where you're all in and everything's bet on a certain move to take place. And this is what I emphasize to people I teach when I teach options to, because options can be very addictive. People get some of those gambling, a lot of those gambling characteristics when they trade options, and they put themselves in positions where they're all in all the time. And I've been doing that I've been trading options a long time, and I know that if you can consistently put yourself in positions where you're all in, you're going to be wiped out. It's going to happen. You might as well just take that money and go donate it to your favorite charity, because at least something good can come out of giving that money away instead of just giving it to some greedy people in the stock market. But it's good to go back and it's good to see sometimes when things don't always work out the way we expect them to, because that's the one thing I always worry about when I'm teaching the stuff in classes, that sometimes I'll go through that and say, we're getting the sideways move, we should move up, and then we move up, and it starts to happen a number of times. It can cause students to believe it always works, and they tune me out when I say nothing is absolute, and sometimes the markets can do the lower probability move. If you haven't seen it, you're not burned by it yet, or you don't think it's possible that it could do the lower probability move. So I always like to point out times when I'm wrong, because then it can help emphasize the importance of other trading principles like money management, trade management, how critical those things are to the process. All right, let's move on down the list here. The Dow chart's pretty much the same. NASDAQ, again, to kind of gauge the health of a rally, you're going to want to pay attention to the NASDAQ 100 and the Russell 2000. Small cap, particularly the Russell in a way, because those small caps tend to be a leading indicator of the market. As I've mentioned many times, it's one of the reasons why we'll focus on it. You can see here that the candle on the Russell is really indecisive today. So it's a very subtle clue right here, but it's showing you that small caps aren't participating as much in the rally. That could be a little bit of a warning sign that this could just be a correction within the downtrend. What should start to happen if there's a little bit more credibility to the rally is you'll see the small caps outperform the other indexes. You'll see the Russell 2000 up 2% for the day when the Dow might only be up 1% or something like that. You'll see an outperformance of the small caps. So that's something we'll keep an eye on for Thursday to see if that was a little bit of a warning sign today that the Russell was a little bit weak. The candle was a little bit weaker than the other indexes were showing. Bonds, we're getting a little bit of a back and forth in bonds, which is just looks like it's just a correction within the downtrend. We saw something similar right here where we kind of went back and forth a little bit and then had another move lower. We've gone to a lower low. This could just be just an oversold bounce. We'll see how that looks on Thursday. But again, the more the sideways look here, it's acting like a correction within the downtrend, and that's what we'll assume is that bonds are still in that downtrend. Gold, same old story on gold. But again, it's worth noting that we're kind of in this sideways range right here, and because of that, the real simple way to deal with this gold chart, knowing that it's not sustaining a lot of these moves. Overall, we've been moving sideways here for quite a while. You could just draw a trend line at the top part of this range and the bottom part of this range is bounced off of here. So it's shown that this is a support area. We've had 3 touches up here showing this is resistance. and just wait for it to break out. If it breaks out above here, that'd be more bullish. If it breaks down below here, that'd be more bearish. Right now, it's indecisive or sideways, and we wouldn't want to draw too big of a conclusion as to where it's going to go from here until it can break out of one of those two areas to give us a little bit more, to make it a little bit more of a credible move. Oil has pulled back. We've kind of pulled back to this breakout area right here. Now, I think oil is still trending up, or still going to trend up. Well, I'm going to believe that until it doesn't. I mean, if we start breaking below this support level right here, what used to be resistance is now support. If we start, if this is just a one-day bounce and we're back below this area right here, then maybe I'll think that a bigger correction could be underway. But there's still huge demand for oil. We're in the summer months, which are the big demand season anyway. To me, I still think this is just a correction within the uptrend. Like I said, I'm not dug in on any chart. So if it has another big down day and we break that support level, and this is looking more impulsive to the downside, I might get out and sit on the sidelines a little bit here. But I think this is just a pullback, and I think it'll continue to move higher. I still think this is the strongest sector to be in until it stops acting like an uptrend. But that still looks like I said, just like a pullback within the uptrend there. The dollar's made again a couple weird moves over the last few weeks. A few weeks ago we were talking about this being a correction within the downtrend. This is more impulsive. Then we had this impulsive move up that went to a higher high. Then we had this sharp drop in the dollar last week, and then it came right back on Friday, and today it's down a little bit here, but it's looking like this could be chopping around in here. And if that's the case, you could be forming a little bit of a cup with handle formation, which would be a very bullish formation. The fact that we did break out higher right here would be cause me to be a little bit more bullish on the dollar again. If we move a little bit more sideways here, like I said, that would be a kind of a textbook cup with handle pattern. Now, what would be unique about that? Well, if we were to break out again up here, break above the top of the cup, one of the rule of thumbs with a cup with handle pattern is you can take the distance from the top of the cup to the bottom of the cup and project that distance upward, and that gives you kind of a minimum target. It doesn't mean it's going to go directly there, rally immediately to that area, but in many cases it will get up to that distance. And so that's why traders look for these patterns all the time. As with every pattern, though, they don't always work. And a rule of thumb doesn't, it just by the name doesn't mean it's absolute. Otherwise, we call it a rule or a law or something like that. But it happens enough times to where you can kind of have that reasonable expectation that it can make a move like that. And so that would be very bullish and it probably needs to move sideways a little bit longer. We don't have much of a handle right here yet, but if it does kind of move within this range for a few more weeks and then breaks out, that would be very, very bullish on the dollar if it were to do that. So that's something to keep an eye on. Now, it could be that, the way, like I said, back here, it looked like this was a correction for a move lower. We got this impulsive move up that barely broke out, and then we went right back down again. Could we be right back down to this level within a few days as well? Yeah, that's possible. And if that were to happen, then you'd look at this support area right here. If it bounces off of that, you'd have a larger sideways trend developing that might be correcting this larger move up. That could be a possible behavior there. But right now, we're just kind of guessing on some of these things and where it's at right now with kind of the whipsaw back and forth a little bit. The near-term trend is less clear, but the fact that we did break out right here would cause me to lean a little bit more towards being bullish on the dollar because of that, and that's where I'm going to go with my analysis today, is to say I'm still a little bit more bullish on the dollar until that changes. The way it's acting right now, it's acting more like it wants to go higher. The VIX, again, it's good to see it down today. That's one of the things I was looking for today, is if we rally today and see the VIX drop. It could just be that this is an ABC on the VIX, a bullish ABC pattern, which would be bearish for the market, because that could mean that the VIX could spike up, which means the market would move down. We'll keep an eye on that. It could still drop a little bit further there. Again, I would want to see the VIX take out these previous highs before we're even talking about fear in the market. Because even then, back here, these sell-offs weren't fearful. They weren't panicky sell-offs. There was fear in those sell-offs, but not panic. And so at the minimum, we'd like to see the VIX get above these previous levels here. And so if you're wondering, I don't know what I don't know what the panic sell-off looks like. I don't know what fear looks like in the market. If you need something more visual to tell you that, that's one thing you could look at is does the VIX get above these previous highs over the last few months? It should. If the selling starts to get panicky, it should get up above those levels. Another thing to keep an eye on are the chip stocks. Again, these tend to be leading indicators. We have bounced today, but we're off the highs of the day. Again, it's kind of what we saw on the small caps as well. A little bit of a fade here. We'll see if we fade into the close a little bit. But you'd want to see, consecutive days where you see the chip stocks really start taking off or outperforming the other stocks, particularly the NASDAQ 100. This is we tend to look at the chip stocks in comparison to the NASDAQ 100 to be kind of that leading indicator. And I'm not saying you're going to see something every day that when you're analyzing those two. I think it's just like with the VIX. The VIX doesn't tell you something significant every day. If you feel like you're getting signals from the VIX every day, you're probably overanalyzing stuff. You might be using it wrong or interpreting it wrong. I'd say the same thing with comparing the NASDAQ 100 to the SMH. Again, maybe just a subtle thing that you could see is that we're off the highs of the day on the SMH. Now we could be on the Qs. Let me quickly go back to the Qs real quick, because while I've been talking, maybe all the indexes have been pulling back. Yeah, they pulled back a little bit there. So that might just be what's going on. Is it's just reflecting what the whole market is doing. Same thing with the Dow transports. They're up a little bit. Transports are actually trading lower than where we opened. We gapped up and we're actually trading a little bit lower than where we opened, which would be showing a little bit of weakness in internal weakness in the rally. Although we're up, we're not able to move above where we opened the day. So that's could be viewed as a little bit more, being a little bit more bearish there. Bitcoin is bouncing a little bit right here, but there again, it's kind of an oversold bounce. We had this big drop recently. I'd view that as probably just a little bit of an oversold bounce right there. All right, and I mentioned in the portfolio, all I'm holding right now is oil. I would get back into those hedges if the market looks like it's going to drop again. But I got out of the SOXS on Friday because we had the drop on Thursday, but then we had the market attempting to rally on Friday. You can see right here, you had a bearish reversal candle on the SOXX. Remember, this is going to go up when the market's going down. And so this was indicating that this would go down, which means the market would be going up. And that's what happened. The chip stocks are rallying today. This is down. Now, if the market looks like it's going to start selling off again, I'll jump back into this again. I'm not basing this off of signals or strength ranks or anything. This is just purely, we've been using both the SOXS and the SARK, the SARK. These are inverse ETFs that go opposite of what the market is doing. If the market's going up, these are going down. Market's going down, these are going up. And we're using these to be able to make money when the market sells off. These will go up when the market sells off. But I want to be out of them if the market looks like it could move sideways or if it could rally. And right now I'm going to be sitting out. I did get out of the NOC, Northrop Grumman. We had dipped below, and my stop right below, I think I had it below here. I'd moved it up, and we had dipped below that. Nice little rally today on lighter volume. I'd like to see a little bit of a stronger rally in the overall market before I jump back into these. But this is another area that you can jump back into is aerospace. I talked about, these stocks. A lot of countries are increasing their defense spending. And so any of these companies that sell weapons, they're going to be making money for the next several years. And, we want to look for maybe opportunities to enter into some of those trends. Overall, we've been just kind of consolidating for the last couple months or so. But this is good because if it breaks out of that range, which I thought it was doing right here, but if it breaks out, it could really take off. When you have these long consolidations, when you break out of them, they can really start running very quickly. And so that's something you could wait for if you want to get back into some of these. If you're not in them, you could just wait till the market's bottomed, wait until these start breaking out. No shame in being patient right now. You don't feel like you have to jump into a bunch of stuff or pick a bottom or anything like that. Question: if SMH continues to pull back, would you get back into SARK? Not today. Just because the market is so oversold, it could have some back and forth. I don't want to be just jumping in and out of this every day. Really, I'm looking just to hedge if the market has a big sell-off. And because we're so oversold, I think, well, by the way, let me point out something. When we're oversold, I think this is important to point out. Let's go back to the SPY chart. When the market is oversold like this, it doesn't have to rally to alleviate that oversold condition. Same with overbought. If you've been going up and you're in this uptrend, it doesn't have to pull back to alleviate an overbought condition. It can just move sideways. Sometimes what happens is you'll get overbought and then you'll move sideways, and that will alleviate that overbought condition, and then you can take off from there. We could just bounce back and forth right here, and that could alleviate that oversold condition before heading lower. It doesn't have to rally up, but it's either likely to move sideways or rally up out of this oversold condition. Those are the two likely outcomes here over the next few days. It's always possible it could drop, but that would be the lower probability outcome in this situation, in this condition. And so if two of the three outcomes are that it could go up or move sideways, I don't want to be in a trading instrument that's betting on it dropping. Does that make sense? So now, if it did drop, it means I would miss. I wouldn't be ahead. I'd miss the move. I'd miss the opportunity to make money with the SARK or the SOXS. But I only have USO anyway, so it's not like I'd get killed or anything. I'm mostly in cash, so I don't feel an urgency to use those right now because of the fact that, remember, what I was using them before when I had all the positions before. Let's go back to the portfolio. Remember, I had about half my portfolio in some stocks. I had Chevron. This is going back a couple weeks. I had Chevron. I had a couple oil stock, a few different oil plays. I had the coal stock, the CEIX. I had I can't remember everything I had, but I had a number of bullish positions. So I was a little bit more anxious to have hedges on those positions using the SARK or the SOXS. Whereas now, that's all I have is the USO. There's really no need to hedge. There's no need to have to feel like I got to jump in if the market's starting to drop, jump in with those. Especially, again, in a situation right here where, from a probability standpoint, we're more likely to either move sideways or rally right in this condition right here. And dropping would be the lower probability outcome in this current condition. So, and that's why we do this. That's why we analyze this stuff every week. We're using the software. I go back to that indexes tab. We're using the software to tell us. I mean, these are extremely oversold conditions. Those direction alerts, all of them are at extreme levels. You're at the extreme oversold on the bear market. The momentum is the left side, breadth is the left side, sentiment is still high, but the buy sell ratios are wide. The sentiment indicator is at the green line right here. And so, again, from a probability standpoint, we're more likely to bounce right here or consolidate right here, move a little bit sideways right here. And so, oops, hold on here. I didn't mean to close out my chart here. And that's the benefit of the software is to make sure that I'm not guessing, or I'm not getting sucked into my own sense. I want to be bullish, or I want to be bearish. I want to believe we're going to go lower right here. I want to make sure that I don't get so sucked into my outlook that I ignore what the reality is, what the chart is doing, what these indicators are showing me. Now, in a way, I've still said that I believe that we're heading lower, and I've given you my reasons for saying that I still don't think the selling is done yet. But even with that, I don't have a problem abandoning that if we start rallying and we keep rallying, and you see high volume coming in on these up days, and stocks are looking like uptrends again. I have no problem saying, hey, it's acting like an uptrend. Jump back in. Let's start buying and let's start getting in. I don't have a problem flip-flopping if the data is showing me that I need to flip-flop. So again, that's the point of using the software, though, is that so we don't get so focused on our biases that we ignore reality, ignore what's actually these numbers are showing us. And that's what I've done today. I mean, I've said these are, aside from that panic sell-off, everything is pointing to the fact that we got to be pretty darn close to a bottom with all the stuff that's showing up right now, and that's what the data is telling us. All right. As far as new trades, like I said, I'm going to wait till Thursday. I want to see if there's more of a bounce here than a one-day bounce. Like I said, back to our SPY chart. We, like I said, last Wednesday, it looked like, by the way, last Wednesday, we were kind of looking like this. We faded into the close. That's what created that indecision candle at the close. It kind of faded into the close. I'd like to see if there's a little bit more confirmation that that we could rally a little bit more, and then we'll see if we can start getting into a couple positions again. Maybe we'll get back into some, if oil starts to rally back up again, maybe there'll be some oil stocks we can jump back into again, build a little bit more of an oil position again, something like that. But I'm going to wait till Thursday on that because I just think it's a little bit risky to add too much right here. All right, that's all I have. Have a great week. I know it's a weird week because the holiday on Monday, it always throws me off. Today feels like Monday. And so really Thursday's not too far away. It'll be here before we know it. We'll see if we get a little bit of confirmation on this. We'll see if we have some stocks we can jump into. We'll have a little bit more ideas at that point that we could maybe get back into at that point. All right, thanks everyone. Have a great week. We'll see you on Thursday for the stock specific class. Bye now.